Today we're going to be talking about how to trade a false breakout, okay, or how to trade it on a simple pattern through an intraday basis. So that gives us quite an exciting, quite an interesting topic for us to discuss here. But as always, as I said, appreciate you being here today. Okay, if you're joining us here live, or if you're watching us later on YouTube channel, if you've enjoyed this video, if you find it's going to be useful for you, give us a thumbs up. Be sure to make sure that you subscribe to the Admirals channel beforehand. And also, even if you just feel as if you've got some ideas for future topics that you'd like to see us cover for you, then by all means, either put them in the chat box or put them in the commentary box on the YouTube channel. We do take on board those. We do actually try to build it in. We're hoping, me and my colleagues Marcus and Jens, that we're able to sort of provide fantastic and useful sort of topics and information for you. So if you've got any thoughts or things you'd particularly like to see, then be sure to put them in, and we'll happily take that on board. But as I say, great to see you join me here. And if you'll bear with us a moment, what we're going to do is I'll switch across to the slides and we'll talk about our topic for today. Super. So here we are, ladies and gentlemen. Here we are to talk about how to trade a simple false breakout, okay? How to turn a price action failure into a trading opportunity. And it would be great to hear from people's own experience today, because as always, I appreciate we have a wide range of experience in the room, from complete beginners at one end to very experienced traders at the others. You're all very welcome, and hopefully we're just going to try and provide something that will give everyone a little bit of value, something that you can take away and utilize in your own particular trading endeavors. So it'd be good to know what do you know about trading a false breakout or a fake out? And do you know what it is? Have you traded it? Have you had your own experiences? Have you found it tough? Have you found it useful? Is it part of your own everyday trading plan? It'd be great to actually understand and hear what your own particular experience is. And as I said, it's great to have you all here. Thanks, Tina. Great to have you here, and all the rest of you. I know we have a wide range of people come from all over the world to join us. It's great to have you here on your own trading journey. So as always, very quickly, for those of you joining us the first time, you may have recognized that Admiral Markets is now Admirals. It's just part of a 20th anniversary rebrand. Doesn't really make any difference to you in terms of your way you engage with markets or where you engage with Admirals. It's just so that you're aware of the new branding and how the company is actually seen. And Admirals themselves, as I say, they're a Forex and CFD broker with a wide range of instruments that you can trade on. They have global presence with local support. They're licensed and regulated across a wide range of regulatory environments, providing competitive spreads on the most popular trading products, and giving the opportunity to engage with markets on the very popular MT4, MT5, and also the old Admirals Supreme Edition. So if you have any questions about Admirals, please get in touch with your account representative, and they'll be very happy to help guide you. And for those of you who are savvy with social media, you can also follow Admirals now on Instagram. You can see them there at Admirals Global. Be sure to hit them up, give them a follow and a like on Instagram, because there you'll see all sorts of notice and news about forthcoming webinars, but also the whole wide range of educational resources that they provide to traders. So what we're going to talk about today, well, not unsurprisingly, we're going to talk about, well, what is a false breakout? We'll talk about how do we use them, and we'll talk about a little bit about, what is a simple false breakout setup for us to use in intraday trading. And that's where we're going to focus on a lot today, because we did maybe, 6 to 9 months ago, we did a webinar on kind of false breakouts, but that was more focused on ways to trade it on sort of higher time frames, so sort of kind of daily charts. Today, I'm just going to sort of show and share, just a very simple way to do it on an intraday basis. Okay, and we're just going to try and boil it down to something that's very simple to see, very simple to recognize, and simple to basically to trade, because actually, if you're using it on an intraday basis, things can happen very fast, and so you don't actually want anything particularly complex. You want something that's quite simple, quite visual, something that actually you can use the tools to help you with, and be able to do that and to trade straight away should that opportunity arise for you. So Peter says he's been trading a lot of false breakouts lately. That's great to hear, Peter. Okay, that's you know, we look forward to hearing what your own kind of particular experiences have been. I, you know, on a personal level, I particularly like them myself as well for various reasons. And as I said, we'll touch on a little bit about that as we go later into the actual webinar itself. So for those who don't know, my name's Paul. I've been trading for many years. I've traded for hedge funds and for high net worth individuals. Okay, primarily my focus on trading is FX indices, commodities. For longer term trading, I tend to be a trend trader, and for shorter term intraday trading, I tend to be a mean reversion, reversal trader, which false breakouts make up as part of. So I'll be sharing just a little bit of my experience today with you, and I hope that gives you something to take away and work upon. So how to trade false breakouts. So as the slide says there, many traders like to trade breakouts of ranges as their main method. When they work, they can work well, but they do not work all the time. And when they fail, that can actually present us with an opportunity. And today we're going to focus on false breakouts on an intraday basis. And I'm going to talk about, as I said, just a very, very simple style of them for an intraday basis. But what we'll do is we'll remind ourselves of the kind of main trading styles, because as I said, I appreciate we do have a wide range of experience joining us in the room. And as Vincenzo, very experienced trader, great to see you. Great to see you here, Vincenzo. As always, nice to have you here. Nice to have everybody here. I see we've got a good crowd. And so yeah, as I say, it would be great to hear. You know, if you've had trading experience of false breakouts, be great. You know, let me know. You can just point yes or no if you've had that. Okay, just, you know, what have you learned? What was your own particular experience? Was there anything that worked well? Was there anything that you found really challenging or struggling? Is there any particular way that, or particular instruments that you know, that kind of you found helped you? I'm going to be sharing it primarily on FX markets, but you know, what I'll be showing and sharing with you can use across all sort of all instruments. Okay, false breakouts are not just the prevalence of the FX markets. You'll find they happen across all markets. Okay, so yeah, so as I said, let's start by reminding ourselves of the main trading styles. So, you know, and you heard from me talk about this lots of time over the last 18 months or so of, you know, providing these webinars, is that when it comes to trading methods, okay, trading investing methods, that, you know, there are thousands out there. All right, you can go onto the internet, and I'm sure you have done. All right, you can tap away looking for, you know, trading methods, and you will find, you know, there are thousands of them. Okay, so from free ones to very expensive ones. Okay, but what you've learned, or you learn over the years, is that realistically that they mostly boil down to one of two styles. Okay, you're either trading a break of a line of support resistance or a bounce off a line of support resistance. It's as simple as that. There might be lots of different, you know, complicated, elegant ways, okay, of being able to sort of, you know, identify and develop trading methods, but realistically, that's what we've kind of, for the most part, found. You're trading a break of a line of support or resistance, or you're trading a bounce off a line of support or resistance. All right, that's what we come down to. Okay, and you know, that can actually be very helpful. That can be actually quite what's the word I'm trying to imagine, you know, it can be kind of really helpful for new traders. Okay, because sometimes, you know, men included, and I include myself in that, sometimes we overcomplicate things. Right, you know, we need, you know, we can't imagine that something can be as simple as that. We need to think, oh, there's more to it. We need to make it more complex, more complicated. And actually, we don't. All right, actually, we just need to understand the simple essence of what it is we're doing. All right, and as I said, loads of trading styles out there, but very often they boil down to either break of a line of support resistance or a bounce off a line of support resistance. And when you tend to understand that, realize, well, then actually the way you view markets can change, and the way you view trading opportunities, they can change, and that can actually help you enormously. So, you know, listen, you know, for trading a breakout, okay, you know, for very new traders, you're always looking to identify kind of levels of particular resistance, whether it be, you know, on big charts or here on a kind of old 15-minute chart. Okay, you're always looking to trade, you know, identify levels of resistance or support, and invariably what you're looking to do is, you know, you're identifying the kind of the breakout of that. Right, and as I say, when breakouts work, they work very, very well. All right, so they work very, very well. On the flip side of it, well, you know, you might be actually trading a bounce off a level of support resistance in there. This is, you know, this is a daily chart of the euro dollar, but what you've got there is there's lots of bounces off the red, which is the 50-period moving average. But you can also see that actually also on many of those occasions, they come in alignment with horizontal levels of support resistance as well. So, you know, as I said, you're either trading a breakthrough, okay, or you're trading a bounce off. And those levels of support resistance, they can be either horizontal levels of support resistance, they could be a big round number, okay, a 000 number, or they could be dynamic levels of support resistance, something like a trend line or a moving average, which is something I particularly quite like to work with myself. So as I said, it's just about trying to understand, you know, very simple, okay, what it is at its most simple and basic levels. And I put this chart up, even though we're going to focus on intraday, I put this chart up really because even though this is a weekly chart, because it's a great chart, because actually it shows that markets can, in this particular case, spend about 4 years bouncing between particular level of support resistance before it actually breaks out. So, you know, on this, what's this, Kiwi yen, you know, for years it bounced off 58 as a level of horizontal support and had 69 as a level of horizontal resistance, and, you know, literally went through there for, you know, nearly 4 years, okay, before it eventually broke out and then carried on. So as I say, when a breakout is true and carries on, it can be enormously successful. But equally, when, you know, when a price fails to break out, okay, when a price bounces off a particular level of support resistance, well, that in itself is a trading opportunity. And what we're going to talk about today is a simple way to be able to show that. So, you know, when it comes to trading and trading methods, you know, whether you're going to trade breakouts or you're going to trade bounces, they both have their pros and cons. Okay, there is, you know, there is nothing that works 100% of the time. All right, there is absolutely, you know, nothing like that. And if everybody tells you there is, okay, then invariably, you know, they're talking nonsense. What you find is some people prefer trading breakouts, some people prefer trading bounces. Okay, I know for myself personally, I prefer to trade bounces, okay, as part of a personally, as part of a pullback in a trend. That's my ideal, because it gives me an opportunity to enter at a better price. And also, which might sound strange, is if I'm going to be wrong, I know I'm wrong far sooner. But equally, I also love trading a breakout when it fails. And so when it fails to break out, it actually bounces and falls away, okay? And that is a very simple, okay? It's a very simple setup. It's a very easy setup to recognize. And it's actually a very, you know, I found it a very simple and very profitable way to trade, so long as you know what you're doing, so long as you keep it simple, as long as you don't overcomplicate matters too much. And that's what we're going to talk about today, okay? That's what we're going to try and focus on. So, as it says, breakouts fail all the time, and I find, especially in the FX markets, they fail a great deal of time. My own view would be, this is just anecdotally from my own experiences, that breakouts fail more than they follow through. Okay, and that's just from my own trading experience. There might be people who would have a different opinion of that, and that's fair enough. I can only talk from my own experience as trader. So, you know, for many breakout traders, when that breakout fails, it means, you know, a failed trade. Okay, they believe that's the, you know, it's the failed trade. That's the, you know, the opportunity is gone and they have lost. However, you know, for a patient and educated trader, it also offers us opportunity, and that's what we're all here for. I mean, we're all come to the markets looking for opportunity. And you know, so let's take a look at how we could trade these failed breakouts, false breakouts, sometimes called fake outs. However you wish to label it is your own choice. Okay, you know, whatever floats your boat. Okay, but at least hopefully you can, you know, when you hear other traders talking about failed breakouts, false breakouts, fake outs, okay, at least you'll, you know, for the very new traders here joining us, you'll actually have an idea and understanding of what that particularly looks like. All right, and that's what we want to share, and that's what we want to take a little look at and sort of see if, you know, we can identify opportunities. So for those of you who joined us, you know, when we looked at failed breakouts on kind of longer term basis, you know, we did that video about, I think it might be about 6 to 9 months ago. You can find that video, okay, in the Admirals YouTube channel. You'll be able to do that. So by all means, just go into the access that fantastic resource. You know, there's tons of videos on there, you know, some fantastic resource there for you to take avail of, okay, and help you with your own trading. But what I did, you know, in that particular video, we talked about trading them on a longer term basis, and in particular, what we were looking for in that video, and there is an example of it here, okay. Let me just bring up the old drawing tool here. Is that, you know, we were looking for, okay, where you would actually see quite a few touches of a particular level. All right, we were looking for 2-3 touches before we saw a failed breakout and price falling away. Okay, and that's sort of and that. And I would suggest go back a video, even though that we talked about in particular in terms of, as I say, longer term trading. It is still valid for intraday trading. In this chart here I showed from a couple of months ago, but this is actually the 5-minute chart, okay, for the pound against the US dollar. So that false breakout setup is valid, okay, and will work at the lower time frames. I just personally don't find that they happen as often as we would like. Okay, that's the kind of the downside of that particular kind of failed breakout side, is that actually trying to find where you might see, like, as I say, 1, 2, 3, 4 touches, 3-4 touches of one particular kind of identified level that basically it fails to trade through. It doesn't happen as often as you would like to see. Okay, it does happen, but just not as often as you'd like to see. Okay, so you could be waiting a month of Sundays for that specific setup to occur. But as I say, if you're trading that on a daily time frame, well then you might only have to check in 10 minutes in the morning just to have a look at your favorite trading instruments to see if that particular setup has worked. Whereas if you were trading on an intraday basis, you could be sat there all day waiting for one particular setup. So as I say, it's valid, it works, it just doesn't happen as often as we would like, and so that's one of the downsides of that particular style of failed breakout. So I'm just going to show you kind of a little bit more of a simpler version of it, okay, today, that you can take away and utilize in your own particular trading endeavors. So here we go. Let's talk about an intraday simple false breakout short setup. Okay, and this is valid. This is valid for kind of 1, 3, 5, 15, 30-minute charts, okay, because we're looking at this on an intraday basis. All right, we're looking for this for a short intraday trading, and in July I'm going to be doing a video on scalping in particular, and trading the kind of very, very short time frames. So be sure to keep an eye out for that. Look out for it. Come and join me for that. But today, I think I'm going to sort of I'm going to kind of look primarily focus on kind of 5 and 15-minute and 30-minute charts. But you can trade this down to shorter time frames because it's a simple setup that that occurs. It's a simple false breakout. What we're looking for short is we're looking for a minimum of like a 1 touch of a level of resistance. Okay, that's it, just 1 touch. All right, we're going to have 1 touch and price action. What are we looking for that resistance to be? Well, it might well be a big round number. Okay, so I don't know, 140 in pound against US dollar. Okay, 000 numbers. All right, we can have the other handles. Okay, but particularly we look big round numbers, whether that be on, as I said, an FX, or for example, for those of you who are let's say following Wall Street bets traders, as the price in silver rallies its way up to $30, that's a big round number. Okay, and actually I traded a false breakout of it a few months ago when it lasted. Maybe we'll try and find that in a little bit. But once again, if you're looking at price coming up to big round numbers, well then that might be an opportunity for you to look for this very simple false breakout. And remember, for big round numbers, here's a little tip that you can take away. Remember, the MetaTrader platforms have the ability for you to set alerts. So if you are, intraday trading and that, one of the instruments you're looking for is in the region of a big round number, well, there's nothing to say that you can't set an alert on your MetaTrader profile platform just in front of that big round number to alert you as price drifts away towards that, which means you're not having to sit there and watching every single candle fail and complete and press. Okay, you can use the tools you have to help you. So, but as I said, a touch of resistance, either a big round number, an existing level of resistance, and if you remember, from the very start of the webinars we've done here in our Admirals, we've always talked about, even if you're an intraday trader, you should be doing, simple steps to start. Every time you open an instrument, you should be looking to draw in levels of support and resistance from monthly, weekly, daily charts. Okay, because actually what will happen is you'll see that they will still be valid on shorter term intraday markets. So touch resistance, either a big round number, a significant level of resistance, or in particular for intraday, previous day's highs, okay, or previous week's highs, they can become very useful as well. All right, previous day's highs or previous week's highs, okay, they actually will become very very useful. Vera's asking, is the webinar recorded? Coming out the recording later. Yes, Vera, the webinar is being recorded, okay, and then what will happen is you'll find it, it'll be replayed again in the next day or two's time, and then it will be on the Admirals YouTube channel where you can actually access it. So be sure to do that, okay. And as I said, if you find it useful, if you're watching this on YouTube, give us a little like, okay, drop us a comment, okay, let us know what you think. If let us know if this has helped you, okay, because that's what we're looking for. So as I said, big round number, level of resistance, or previous day or previous week's high, okay, can be very, very useful. We want to see price touch the level, and then what happens is it reverses off the level. And ideally, preferably, we'll print a bearish pin bar, or maybe even another form of rejection candle, but as normally a bearish pin bar with a bearish close below the level, okay, that it's touched. And what we have there then is that's that false breakout. And what we're looking to do is we look to sell the break of that rejection candle or pin bar. And what we have here is this is like a chart here, okay, Asian session, okay, then we come into the European session. Actually, this blue line on my charts, that will have been a kind of previous day's high, and hopefully what you can see is the price pushed up to the previous day's high, literally touched it, went up by about a pip above it, which probably would have taken in some breakout traders. Okay, there will have been breakout traders who probably bought here at the break of the Asian session, and there will probably be traders there who have a kind of who had a buy order there, level there above, literally just above the previous day's high. But what you can actually see, now I'm just going to clear this thing, and as I say, I'm a better trader than I am an artist, so please forgive my drawing on the charts, but hopefully you get the gist of what I'm trying to show here. Price in that 15-minute chart, it went up, it tapped it, came back down, and closed. Okay, closed beneath the level. There's a rejection candle, it's a pin bar, and then basically what we're looking to do is we need to sell, okay, to sell the break to begin with for the basic version, to sell the break, okay, of that pin bar. Our stop loss would go above the high, and then ideally, what I'd say, on an intraday basis, you're looking for about a 1.5 reward to risk. But there's that always saying of invariably don't be a dick for a tick. So in this particular case, when we see our price runs down into the sort of 200 period moving average, that would have been the trade. But actually, you can see that the price actually really sort of drifted down much further. So part of your target might well be dependent upon your own particular risk profile. But what I'd be saying is it should really be a minimum of 1.5 to 1. All right, that's the ideal. So stop loss, not unsurprisingly, goes above the recent high. Okay, just by normally for when you're shorting it, in this particular case, my stop would be a couple of pips plus the spread above the high of that candle. Your entry, as I said, is the kind of the break of that pin bar rejection candle, and your target would be normally about 1.5, at least 1.5 to 1. Okay, so actually, if you're operating on that level, once the trade is triggered, and you make sure that your stop loss is in place and your target's in place, that trade could be left just to play out for itself. Okay, now I appreciate some traders here today will love to try and run a trade as much as they can. They like to sort of trail their stops in ways that can do that. I'm not averse to that. Okay, as you can see in that particular case, what we pinned there, that pin bar was literally the high of the European session before price actually sort of collapsed its way all the way down. Okay, so there will be days and occasions when that happens, and I can understand that if you like to use trailing stops, that might do it, because that would provide you the opportunity to basically sort of to try and ride that as much as you can. Personally, for me, I'm an ex-military guy. I like to hit targets. Okay, give me a target, I like to hit it. So for me, the trade is on. My entry, I know where my entry is. I know where my stop loss is. I know where my target is. It's the trade either flies or it dies. Okay, that's the way that kind of suits my style of trading. But I appreciate other people may well be a little bit different in how they particularly wish to manage the trade. So you can do it as long as there's a stop loss in place. Okay, so long as you have an asymmetric reward to risk. Okay, don't be risking 1R to make 0.3R. That's not the way to trade. Okay, you want to be at least 1.5R, and 1.5R. Okay, that generally just means if you have 50% hit rate and above, well, you have positive expectancy. Okay, and that's that's a kind of, let's say, that's deeper conversation for maybe another session in the future. Here at the moment, we're just looking at that. So as I said, is it kind of trying to simplify, all right, a simple false breakout short setup, all right? You're looking for a price to touch resistance, a big round number, a level of resistance, a previous day or a previous week's high. Price touches that level and then it rejects that level, okay? It might only go above it by a pip or two, okay? It doesn't really matter, okay? It rejects that level, it comes down and it closes beneath that level. And hopefully the price action, that should be bearish pin bar, rejection candle. That, okay, ladies and gentlemen, that is a very simple false breakout that occurred. And what we're expecting is we're expecting price to go the other way. And so we're basically looking, in this case, we'll be looking to sell the break of the rejection candle, sell the break of the pin bar itself. So let us know what you think about that. Do you think that's simple? Do you think that's quite, could you do that? Could you actually follow that through? Okay, is that something that is quite visual, quite simple? It's not necessarily complex. As I said, an intraday market, things can happen quite fast. So actually having over elaborate, okay, overly complex trading methods during an intraday trading doesn't really work, doesn't help you, trust me. I used to work, I was an intraday FX trader for a hedge fund many years ago. All right, you want your trading method to be simple, okay? It's simple for you to see, simple for you to be able to pull the trigger, simple for you to be able to manage, okay? And it becomes about not just the one trade, but samples of 20, 50, 100, 200, 250, 500 trades. And and what I learned, okay, is a simple plan executed flawlessly will always beat a complex method that is executed poorly, okay? The great military generals of the past would probably tell you this exactly the same. All right, a simple plan flawlessly executed will always beat an elaborate battle plan, okay, that has just got too many working parts, because then invariably these things can go wrong and go wrong quite quickly. Just simple, short, false breakout setup, okay? Look at these, you'll see it on the 1, the 3 minutes, okay? Also 5, 15, 30, okay? And to be fair, you'll see that setup on hourly charts, 4 hourly, daily, weekly, even monthly, okay? But for the focus of today, we're just going to be looking at simple false breakouts for intraday trades. That's what we particularly want to look at. So it's just a couple of examples here, okay? Just a couple of examples there. This is let's get the old drawing tool up again, shall we? Here. So this is pound against dollar, 15-minute chart. This is from earlier this week, okay? So just so give you an idea of the kind of the thing. That grey box is the overnight Asian range. You can see some of them, the blue levels here, okay, previous week's low, okay, that will have been previous day's high. This will be previous day's low there, and we can see price breaks out, okay, price breaks out of this kind of Asian range and actually moves its way quite up nicely. If I just let's just clear that a little bit down, just to give you a bit of just give me a bit of context. Price breaks through, okay, price comes up, it drifts its way back down to, this is the 141, big round number, double zero number. Price in its own way does a little false breakout there before it actually sort of moves its way up. And then what we see is price pushes up to this level, okay, previous day's high. You can see price, in that 15-minute trades up through it, but actually it can't go above it, okay, it can't break out, all right, it's false breakout, it's failing. Price collapses and price then closes beneath the low. It's giving us closing beneath the level, okay, it's closed beneath its open. It's given us here, all right, it's given us here, it's there is failed breakout, okay, at a significant level, previous day's high. There's also printed a pin bar rejection candle. The trade is on, ladies and gentlemen. All right, the trade is on. So remember what we're looking to do. Okay, as soon as we recognize that, well, then invariably what we have is we're trading. Our entry will be short of the sort of selling just beneath the low of the candle. So normally kind of like 1-2 pips beneath the low of the candle. I'll stop. Okay, for a trade like this, for sure, it'd be like normally one pip plus the spread above the high, and then you're targeting, okay, around about 1.5 to 1, which was actually down towards that 141 number anyway. So just quite simple, all right, quite simple, nothing terribly complex, okay, is nothing terribly harsh. Vera asks, is the false break on D or any time frame? To be fair, this could be on any time frame, all right, it could, the idea is simple, all right, okay, it could be on any time frame, but for today what we're just focusing on is just the sort of the shorter time frames, intraday time frames. But the general concept of Vera is excuse me, will work just effectively as well across any time frames. All right, so this could be 15-minute chart, and that's what we're focusing on, the kind of shorter time frames. All right, and as I've just said, that's the reason why we're having it. It's a simple one, because you know, you don't want complex plans, all right, when you're intraday trading, right? You just want a simple visual setup. See it, okay, see the trade, take the trade, okay, execute the trade, manage the trade, exit the trade, debrief the trade, repeat the trade. That's, you know, that's it. That becomes your kind of mantle, all right. You know, the mantra, rather, sorry, I apologize. You know, just see the trade, okay, take the trade, all right, manage the trade, exit the trade, debrief the trade, repeat the trade. You know, it is just become like, you know, sort of a mantra, and that's what you particularly look at and work at and do. That's what we're looking at. And yeah, as I said, because things happen quite fast on intraday timeframes, excuse me, you know, the simpler the plan, the better for you, because you'll be more able to sort of execute it consistently, and that's what we're looking for. Lauren says, what if the candle closes without giving you a pin bar but gives you indecision candle? Will you consider the breakout to be valid? That's a good question, Lawrence. Okay. Personally, what I would be suggesting to people to begin with, if you're a new trader starting this, is, you know, only trade when you see a very clear pin bar stroke rejection candle. Okay, that is what I'd be saying. So, you know, the candle might have actually gone up, pressed, and then becomes, let's say, an engulfing candle or a key reversal candle. And that's what, you know, I'd be happy with, because you've got a very clear, very visual representation of rejection of that particular level, and the pin bar is the most clear and visual of that. Okay, so my suggestion would be, to begin with, Lawrence, just look for, you know, very clear pin bars, okay, to do that. Vera asks, is there an indicator to put on for the weekly and day levels? Yes, there are. Okay, there are indicators you can find out there, okay, for both MT4 and MT5. They'll basically will just print for you the previous day, the previous day and the previous week's highs and lows. Okay, you're able to find them, and as you say, it just prints it on there, and that actually helps and gives you a normal helps. Okay, so just answering a couple of questions here. So Brian says, Paul, there's a reasonable level of resistance just below where you're saying sell. Would you wait to see if the price broke to the level? Not on this particular case, okay, because I know that what is actually likely to happen is that if price is rejecting that level, well, then actually it is probably more likely to drift down to that sort of support level there, and within that provides me with like a 1.5 reward to risk. Now, actually, what you can see happens later on is actually price completely collapsed. Now that's to do with that would be to do with FOMC and stuff. That was a kind of Wednesday evening. So we're not really we're not really interested in that at the moment as the kind of intraday. What we're looking at is, you know, this is just effectively, you know, a kind of very simple trade. All right, prices traded up to the previous day's highs. Prices tried to break out the previous day's highs. It failed. It rolled over. It printed a rejection candle in a nice bearish pin bar. We sell the break of the low, stop above the high, target 1.5 to 1 away. Okay, and the trade either flies or it dies. Okay, and that's the trade on for us. So here's a kind of another, I want to show a couple of different examples. So this is the pound against the Swiss franc here, 15-minute chart once again. Okay, the old drawing tool, you can see there, 15-minute chart. Excuse me. And once again, you can see, the gray area is the kind of the Asian session here. We've got the previous day's high here. We can see that prices it starts off the day not terribly exciting, but then actually it trades its way up to the previous day's high. And then what does it do? The first one is a little bit like actually what I think Brian said, is it kind of looks more like a little bit of an indecision candle. Okay, maybe you're getting towards a doji, but then we're certainly getting, what we're getting is we're getting a couple of very interesting, there's about 3-4 there kind of rejection candle pin bars, okay, that allow you to effectively, you're seeing that there's lots of wicks to the upside there, isn't it? All right, price isn't going higher right now. Okay, price ain't getting above that level. It has failed to break at that level. All right, it has failed to break that level. So what you're looking to do is, once again, as I said, you're shorting 1 to 2 pips beneath the low, stop above the recent high plus the spread, and then you're looking to target, okay, 1.5 to 1. All right, that's fine. Actually, what you see is price comes back up, all right, and pins towards it. In a way that was also valid, but the thing is, by this time of the day, pound against Swiss, all right, kind of from sort of 5 o'clock onwards, I'm when I'm intraday trading, I'm kind of done for the day, or if I am trading, I'm looking at the US indices then. All right, so but this one here into the kind of it getting towards the US Open. All right, just a nice, all right, traded up to the previous day's high, puts in quite a few rejection candles and pin bars there before it rolls over and falls away. All right, and that's that's quite a simple setup, isn't it? Quite a simple trade. Okay, quite visual, quite simple to see. You quite clearly to know where you're getting in. You quite clearly know where you're getting out. Quite clearly to know where where you can trade towards in terms of having a particular target in place. So let's have a little look at the shorts, the opposite side. Okay, there's always two sides, isn't there? So let's have a little look at an intraday simple false breakout long setup. Okay, and it's really not that. There's it's pretty much just more of the same, really, ladies. I mean, nice and kind of simple, nothing too extravagant. All right, so we're looking at those kind of 1, 3, 5, 15, 30-minute charts. We're looking for a touch of support. All right, which can be a big round number. All right, big round number. That should be, sorry, a level of support. Okay, that should read not so resist, a level of support. Okay, so that could be a horizontal level of support. All right, the previous day or the previous week's low. That's that's what we'll be looking for. Okay, we're looking for a price touches that level and then prints a bullish pin bar. Okay, with a bullish close. Okay, above that particular level, which is create a false breakout. And we buy the breakout of the rejection candle of the pin bar. Okay, and this is well, I'm going to add a little piece in here for you to help traders. Okay, because I appreciate that traders, you're either a fear-based trader or a greed-based trader, right? Greed-based traders are happy to sort of just hammer away and trade everything, but sometimes fear-based traders, they need more confirmation before they're happy to take the trade. So we'll touch on that a little bit as we go through it. But that's it's particularly what we're looking for, okay, in terms of the kind of the simple element. Just very, very simple, to basically provide the trader with the opportunity. Vera says, thanks, it's been a great webinar. You're very kind, Vera. We're not finished yet. There's still 5-10 minutes to go. All right, so there's still plenty of good stuff in here to keep you excited. All right, so but thank you, I appreciate the feedback. I hope pleased to see that you found it useful. So this is kind of an interesting one from he kind of traded I traded the other day. So this is actually the pound against dollar on the 1-minute chart. Now I would not be suggesting that you start out trying to trade this on the 1-minute chart. Okay, maybe wait until join me in July when I'm doing a webinar on scalping. Okay, that might be useful. But what I want to show you is that the concept is the same. Okay, it's price action. You can see here that price has been down here. This is like the kind of 141 level here, right? Okay, excuse me. And price has been down to 141, and so we can see that, and you can see that price has been in a downtrend, hasn't it? You can see that actually price tapped it, okay, earlier in the session. All right, earlier in the session, but it was a rejection candle, but it's nothing terribly clear. But actually what happens is it comes down again and it puts in, it actually prints kind of two bullish pin bars there, okay, which have two bullish pin bars there, which have now given you the opportunity. Okay, so not only could you just trade it off that, but depending upon your particular style of technical analysis, so some people would now see this is a double bottom, okay, which gives you the opportunity to take your trade. Some people would see this as actually part of a descending triangle which has failed, which they can indeed, all right, and some people will look at that. Whereas actually what you're looking to do is just effectively just a very, very quick short trade, okay, up to generate your 1.5-1 reward to risk. It actually went a good bit up before it rolled over. But what we're just looking at here is it's just that simple setup. Price has come down to a level of support that is significant and clear. Okay, 141. It's bounced off it already. It's actually bounced off it a couple of times already. And then basically what we see is we have that kind of price fails to break out, prints bullish pin bars, and price rejects and runs away from that. Okay, so as I say, it's quite simple, it's quite clear. You know what you're to do. You're here to you buy effectively 1 pip plus the spread above the high, stop goes beneath the low, trade like 1.5 to 1, okay, and just let the trade. I let the trade sort of kind of fly or die. That's the way I particularly like to trade myself. Now, you know, when you're trading it on the 1 minute chart, okay, you're only trading it for you're only trading for a few pips, okay. I think it's about 6-7 pips, okay. So you know that's it is a scalping trade, and so what I would suggest is to begin with for new traders is just to look, when you see these setups, follow them, maybe demo trade and paper trade them. Don't try and actively trade them until you've joined me for the webinar on scalping next month, all right? Because that will give you just a little bit more insight and education onto what you need to be aware of. And here's another example. Okay, is that this is pound against New Zealand dollar from, I think it was Tuesday morning, if I remember from my trading 50-minute chart. Prices come out of the kind of Asian session, so it kind of doesn't do a great deal, but then actually it drops away to basically to the previous day's low. All right, to the previous day's low, and as you can see here, okay, price pushes through, but actually it fails. Okay, it fails to continue through, and it actually closes. Right, it's closed now. It is effectively a bullish pin bar, okay, because we have the candle wick is to the lows, okay. So we are expecting price to move up, but as I said, I do appreciate that sometimes some traders, especially fear-based traders, they struggle a little bit with the they want more confirmation. So if you are uncomfortable with that trade, well, then actually what I suggest to traders here is you wait for the next bar to complete. You can have a confirmation bar, which in this case would be this candle here, okay, and what that gives you is a confirmation bar, and that's a very strong bullish candle, okay. And so now what you'd be looking to do is you're very looking to sort of buy the kind of the breakout of the high of that candle, with your stop beneath the low, and with your kind of target 1.5 to 1 away, okay. So what happens is your trade risk increases, okay, because you're waiting for that confirmation bar. For me personally, I'm happy to trade just above once price breaks above that pin bar. But I appreciate I have many years experience. If you're a new trader, you might just want to wait for the confirmation bar to give you that kind of confirmation, and to do that, okay. But the concept is saying prices come down to a level of support, in this case previous day's low. It has failed to break out of it, okay. It's closed back up above that level, all right. The trade is on. Now it's a case of getting your trade on, getting your stop loss in place, and your target to run as well. Pete says, if you're scalping on the lower time frames, if price is going your way, would you ever change the time frame from maybe 5 to 15 or 15 to 30 and manage on the slightly higher time frame above? I will certainly look through the kind of the 5, 15 and 30 and even the 1 minute for entries, because as price is getting down to that level, you might see the entry early. You might be watching the 15-minute, but then as it gets to that level, you might actually see it sets up on the 5-minute chart earlier. Personally, I tend to, for a trade like that, where it's like kind of flies or it dies, if it's set up on the 15-minute chart, I will let it run on the 15-minute chart, if that makes sense, okay. For general rule, I tend to say, keep it as simple as you can, all right. Keeping it simple is better, because it's not the case of of how it plays out on one trade. It's about how it plays out over 20 trades. So I hope that helps you, Peter, but great question. Thanks for that. And here's kind of just a kind of an interesting example here, okay. This was like for sort of 2 trades, finishes off 2 trades on the kind of the pound against the Aussie, the 15-minute chart from I think it's Tuesday morning again, and what you can see is price actually, it broke out, okay. It broke out to sort of a previous day's high here, went up, didn't it, touched it, rolled over, collapsed, okay, and then basically it ran away. But then in the afternoon session, it ran down to the previous day's low, and then basically pinned it, and it gave you a nice strong confirmation candle as well if you needed it, before it ran back up as well. So you had effectively 2 false breakouts in a day there, okay. So that doesn't happen as often as you'd like, ladies and gentlemen. So I wish I could tell you that's what happens every day. It isn't, all right, okay. Even false breakouts don't happen every day, okay. This was just an interesting day just a couple of days ago that happened really nicely, and it ran nicely. So you can see it and it can happen, but this is where, once you know where the previous day's highs and lows are, you can use tools on the MetaTrader platform to basically maybe put in a little alerts for when price is getting towards those levels, so that if you're doing other stuff, right, if you're not having to watch everything, every candle, you can do that and it alerts you when price is getting up towards that level, and then you can start to sort of hone in your focus as is required. So there you go. In conclusion, ladies and gentlemen, many traders love to trade breakouts, and that's fine. As I say, breakouts can work, but I believe many breakouts fail, especially in FX markets. Okay, and a failed breakout offers an opportunity for savvy traders. Today we looked at failed breakouts on intraday markets, looking for basically a rejection candle or pin bar at a significant level of support or resistance. Remember, that could be a big round number, that could be a horizontal level of support resistance, it might even be a trend line. Or in particular, previous days highs and lows. Okay, wait for price to break that level, but close back the other side of that level as your trigger with a nice pin bar, and that would be your entry. Okay, that's you're sort of trading just the break of that candle, your stop loss the other side of that candle, and as I said, a target about 1.5 to 1. I would have loved for us to have take a little look at the charts, but unfortunately we're kind of running out of time today. Okay, unfortunately, I appreciate that. Try to answer questions and give as much information as I can, but that means we're always a little bit challenged by time. But I hope you found that particularly helpful. So don't forget to join us next time. So on Wednesday, what you're going to have is going to be me, and I'm going to talk about, does the euro have a future? Some of you might be saying that's a bit of a controversial topic there, Paul. You really put your hand in the snake's pit there, but it's interesting because it gives us opportunity for an interesting chat and a debate, doesn't it? So let's talk about who are the winners and losers from the creation of the euro, and what have been the threats and opportunities that it has dealt with, and what is its likely future trajectory. And that will be 2 o'clock Wednesday, 23rd of June. Check your inbox for the webinar link, or head over to the Admirals website, the education element, to be able to work with that. Okay, so there you go. And if you've got contact or if you've got questions, you can do that. Email them at global@admiralmarkets.com. You can look at us, as I said, youtube.com/admiralsglobal, facebook.com/admiralsglobals there. So there you go, ladies and gentlemen. It's I hope you found that useful. Hope you found that insightful. Sorry, unfortunately, we have just run over a little bit of time. Okay, but hopefully there's enough in there to give you some insight that you can take away and utilize in your own particular trading. As I said, this video here is on YouTube. Okay, we'll be on YouTube in the next couple of days. So if you found this useful, please give us a like. If you've got any thoughts, comments, put it in the commentary box, and be sure to make sure you subscribe to the Admirals YouTube channel. So Tina says thank you. James says thanks a lot for the webinar. All right, Vincenzo, thanks for a great webinar. Pete says excellent webinar. Thank you. That's great. I appreciate the feedback. Is always welcome. Okay, as I said, we want to try and give you as much help and assistance as we can. And the feedback is always great. And as I said, if you've got thoughts about future topics you'd like to see, put them in the comment box. We always take them on board. We're always, me, Jens, Marcus, we're always happy to sort of hear what you have to say and to see here how we could help you best. So with that, it just only sort of ends for me to say it's been great to have you here. Thank you for your interaction. I wish you the very, very best of success in your own trading endeavors, ladies and gentlemen. And I look forward to seeing you on the next Admirals webinar. Trade well, everybody. Cheers.